few more here, and we got to wrap this up and do some Q&A. Stocks. We're talking about stocks. Earnings rebound may spark 2021 gains. Yes is the short answer. 6 months later, it's like yes. I mean, the jump we've seen in stocks this year of 15%, really impressive. We've seen earnings actually go up more. So earnings have clearly sparked an incredible bounce. So here's kind of how we see the world. Our fair value target in the S&P is 4,400. That's honestly not too far from where we are right now. And people say, just because you're at your fair value target, I mean, you're bearish now. No, right? We can up our target. I mean, the way I look at it is this is a major structural bull market. Talked about that a little bit ago. The economy keeps improving to the upside, surprising to the upside. We think you'll still be in stocks over bonds. Our big call this year earlier was say stocks will really outperform bonds. They've been really beating bonds a lot. We think that's probably going to continue. I'll talk about bonds. There's always a place for bonds in a portfolio, but we just feel like stocks a little bit over bonds. See here. Neil Ferguson said the debt outnumber the living 14-1. Ignore such accumulated experience at your peril. There's a lot we can learn from the past. Churchill said the further into the past I look, the further into the future I can see. I love using past history for potentially where we're going to go. I have a podcast. Everybody listen to the podcast, LPL Market Signals, Google Play, iTunes, Spotify, YouTube channel, LPL Research YouTube channel. We show the videos there. We've shared a ton of market signals over the past year that are saying, listen, this extremely strong move we saw could lead to a lot higher prices. I've been saying that nonstop for a long time now. We're still seeing signs like that. Recently, as you can see, we had one of the best 12-month rallies ever. What happens after good 12-month rallies? Well, sure enough, look at that. 6 months later, some green, some red, but look at a year later. Big bounces tend to resolve higher eventually over the long run, over the course of a year, because big bounces take place at the start of bull markets where you likely have more expansion. Remember I said the economic cycle is a year old? We just reached year 2 of the bull market, and I got some slides on that coming up. But it just still makes sense to us when you see big picture things like this, that stocks very well can continue to do pretty well. Now, I know a lot of you guys are in Michigan, so you might know this one. Take a look at this guy. Don't judge a book by its cover. Who could it be? There it is. 9-time Super Bowl participant, 6-time Super Bowl winner, Tom Brady. The 199th pick in the draft. I know Belichick picked him, and he's a genius, but 199th, hey, kind of lucked into it if you ask me. But it worked out. Let me get a drink here. So you can't judge a book by its cover, obviously. Which brings us to year 2. Everyone thinks, oh, my God. Last year, stocks were up so much, right? It has to come back down. It has to pull back. No, that's not the case. We are in the second year of the bull market. We've had 10 second years of a bull market. Going back to World War II, the stock market's higher every single time. Not all those are big gains, though. I want to be very clear there. Sometimes you have some choppiness. Look at like 2004. Look at 2010. Look at 1983, 84. Those are all second years of bull markets. They're kind of choppy, all right? Just catch your breath. That's fine. After big rallies, maybe catch your breath the second year of a bull market, but you tend to resolve higher. And that's what this chart shows, where the second year of the bull market's usually higher. Usually don't have quite the gains you did during year one, which makes sense. And pullbacks are normal. You can have about a 10% correction or so, which after a 90% rally, I don't think a 10% correction would be that shocking. We just shared this in our weekly market commentary on Monday. We wrote a weekly market commentary for our advisors and their clients. And right here, you can see this bull market's yellow versus some of the other previous bull markets, best bull markets ever. What happened the next 6 months or so? You tell me. You look at it. Kind of choppy, right? Rally, and then things get kind of choppy. So again, that's not the end, not end of world stuff. It's just stuff you need to be very aware of. So here's earnings. All right. Earnings are helping drive this whole thing. We're looking at 34% earnings growth this year and 12% next year. Honestly, since the time we did this chart, which is about a month ago, it's now like 39% earnings growth in the United States this year, 2021, and even more in 2022. So earnings continue to justify, in our view, this big move we've seen in equities. It's not just a U.S. story. It's a global story. Here is developed international in the middle, emerging markets, and the United States on the left. The left is earnings that were expected, the percent expected at the start of the year. The orange is what's expected now for the full year. All those are up a lot. U.S. is up more than any of them. U.S. has had more of a comeback economically than anywhere else in the world, but it's a global story, the improvement we're seeing in earnings. You know, I won't even talk about that. We talked enough about earnings. What's one of the worries that are out there? Stuff isn't cheap. All right. I mean, PE multiples, it's a geeky way of saying what stuff is worth, what you're paying for, price to earnings multiple. they're the highest they've been since the late 1990s. And people hear highest since late 1990s, you start to get pretty worried that, you know, things are pricey. So this is no doubt a potential worry. But again, when we see things like just a new economic cycle of growth, there's still a accommodative Fed, historically low inflation. I mean, I know some of the recent inflation data has been high. We're still low inflation given where we've been. Lower inflation, you tend to see a higher multiple. So again, it's something we're worried about. Not overly worried about, but just a concern is stocks aren't cheap. Here's the thing, though. Stocks might be not so cheap. Bonds are really expensive, okay? So it's kind of like, which way do you want to go? And I'm going to talk about bonds very, very soon. But again, stocks might be kind of pricey. Bonds are very, very pricey with rates so low. Okay, here we go. Good. So we're up to